Most people think silver rises because of inflation, higher CPI, more money printing, currency losing value, but historically, that explanation misses the real pattern, because silver doesn't truly explode during normal inflation cycles. It explodes when the structure of the financial system begins to change. And right now, several signals are appearing at the same time, signals that rarely appear together. Global debt has passed $300 trillion, major trade routes are becoming unstable. Energy markets are fragmenting, and geopolitical tension is rising across multiple regions. Individually, none of these forces guarantee a dramatic move in silver, but when they start to overlap, markets begin to behave differently. Thoughtful capital begins to reposition. Liquidity starts moving in unusual ways, and certain assets begin reacting before the broader system fully understands why. Surprised, silver has always been one of those assets, because silver is not just a commodity, and it is not simply another precious metal. Silver sits at a strange intersection inside the global economy, part monetary metal, part industrial input, part financial hedge, which means when multiple systems begin experiencing pressure at the same time, silver starts reflecting that pressure. And that is why the idea of $120 silver is often misunderstood. Many people treat it like a prediction, a bold target, a speculative forecast. But in reality, $120 silver is not really a prediction. It is a scenario that emerges when several structural forces begin aligning at the same time. The real question is not whether someone can guess the future price of silver. The real question is something much deeper. What kind of global financial environment would need to exist for silver to reach a level like that? Because once we start asking that question, we are no longer talking about silver alone. We are talking about the architecture of the global financial system itself. And right now, that architecture may be entering a period of change. To understand why silver can move so dramatically, we first need to understand something most investors rarely think about. Silver has played two completely different roles throughout history. One role is obvious: silver as money. For thousands of years, silver circulated directly inside everyday economic life. Coins, trade settlement, daily transactions. Empires across Asia, Europe, and the Americas relied on silver as a monetary foundation. But silver also developed a second role, a role that became increasingly important during the industrial age. Silver became an industrial metal. It conducts electricity better than any other metal. It reflects light extremely efficiently. It resists corrosion, which makes it essential in modern technologies: solar panels, electronics, medical equipment, advanced manufacturing. This dual identity makes silver unique, because it means silver reacts to two different systems at the same time: the monetary system and the industrial production system. Most commodities depend almost entirely on economic growth. If global manufacturing slows, industrial metals usually fall. But silver behaves differently, because when economic stress appears inside the financial system, the monetary demand for silver can rise, even while parts of the industrial economy weaken. This is why silver sometimes behaves quietly for long periods, and then suddenly moves with extreme speed. For years, it can remain trapped between industrial demand cycles and investor attention. But when systemic pressure begins appearing inside the financial architecture, the balance changes. Capital starts searching for assets that sit outside traditional financial structures, assets that cannot be printed, assets that cannot be digitally expanded, assets that have survived multiple monetary systems before. Historically, gold tends to move first. Gold responds quickly to fear, uncertainty, and currency risk, but silver behaves differently. Silver often reacts later, not because it is weaker, but because it requires a stronger signal. It tends to move once the pressure inside the system becomes more structural than emotional, and when that shift happens, silver has historically moved faster than gold, sometimes dramatically faster, which raises an important question. If silver tends to respond when systemic pressure increases, what kind of pressures are building inside the global system today? Because the environment we are seeing now may be setting the stage for exactly the kind of conditions where silver begins to react. To understand the environment silver is reacting to today, we need to step back and look at something much larger than metals: the global debt system. Over the last several decades, the world economy has expanded through a very specific mechanism: debt expansion. Governments borrow to stimulate growth, corporations borrow to expand operations, consumers borrow to increase spending. And for many years, this structure worked. Low interest rates made debt manageable. Central banks provided liquidity during crises, and financial markets absorbed increasing levels of leverage. But the scale of debt today has reached a level that previous monetary systems never experienced. Global debt has now exceeded $300 trillion. That number is difficult to fully visualize, because it represents more than just government obligations. It includes corporate borrowing, household liabilities, financial system leverage, and sovereign debt across both developed and emerging economies. For many years, This debt expansion was sustainable because interest rates remained extremely low. But something changed in the last few years. Inflation forced central banks to tighten policy. Interest rates rose rapidly, and the cost of servicing debt increased across the entire system. This creates a structural tension. On one side, governments and corporations need continued liquidity to manage enormous debt loads. On the other side, high inflation makes unlimited money creation politically and economically dangerous, which leaves the global financial system navigating a narrow corridor. Too much tightening, and the debt structure begins to fracture. Too much liquidity, and currencies begin losing credibility. This tension does not always produce immediate crises. Sometimes it simply produces instability, volatility in bond markets, unusual movements in currency markets, shifts in capital flows. And during these periods, investors begin searching for assets that exist outside the traditional debt structure, assets that do not depend on government balance sheets, assets that do not rely on central bank credibility. Historically, precious metals have filled that role. But silver has a particularly interesting position inside this dynamic, because while gold primarily reflects monetary confidence, silver reflects monetary stress interacting with the real economy. And when both the financial system and the industrial system experience pressure at the same time, silver can begin moving in ways that surprise almost everyone watching the market, which brings us to another critical layer of the current global environment. Because the financial system is not the only structure experiencing stress right now, the global energy system may also be entering a period of instability. Debt pressure alone does not usually trigger a systemic shift. Financial systems have lived with high debt before, but history shows something interesting. Major monetary changes rarely happen because of debt alone. They happen when financial stress overlaps with geopolitical disruption. And right now, the global energy system may be entering exactly that kind of environment. Energy sits at the foundation of the entire global economy. Oil powers transportation, natural gas fuels industry, electricity supports every modern supply chain. When energy markets become unstable, the effects spread quickly through the entire system. Transportation costs rise, manufacturing margins tighten, food prices react, and inflation pressures begin appearing across multiple sectors. But energy instability does something else that is often overlooked. It reshapes global trade relationships. Over the last few decades, globalization created a relatively stable system of energy flows. Oil moved through predictable shipping lanes. Natural gas pipelines linked regions together. Energy producers and energy consumers developed long-term trade relationships. But geopolitical tensions are beginning to disrupt parts of that structure. Sanctions, regional conflicts, trade restrictions, strategic resource competition. These forces do not necessarily stop global trade, but they begin to fragment it. Energy flows become less predictable. Supply chains become more regional. Countries begin prioritizing security over efficiency. And when the structure of global trade begins shifting, capital flows start changing as well. Some currencies strengthen, others weaken. Certain commodities become more strategically valuable, and assets that function outside political systems begin attracting renewed attention. This is where silver enters the conversation again. Because silver is deeply connected to the energy transition itself. Modern solar panels require silver. Electrification infrastructure requires silver. Advanced electronics require silver. In other words, silver is both a monetary asset and a material of industrial transformation, which means when the global economy begins shifting toward a new energy structure, silver demand can increase from multiple directions at the same time. And when multiple demand channels begin interacting, price movements can become extremely nonlinear, slow for long periods, then suddenly explosive. But even this does not fully explain the possibility of something like $120 silver, because one final layer may be even more important than debt or energy: the structure of the global monetary order itself. For most of the modern financial era, the global monetary system has operated around a single central pillar: the US dollar, international trade, energy pricing, global reserves, financial settlement systems. For decades, a large portion of the world economy has flowed through dollar-based infrastructure. This structure created enormous efficiency. Countries could trade using a common financial language. Capital could move quickly across borders. Global markets could operate with a shared reference currency. But systems built on a single central pillar always carry a hidden risk. If too much weight accumulates on that pillar, pressure begins building underneath the structure. And over time, some countries begin looking for alternatives. Not necessarily because they want to replace the system immediately, but because they want optional pathways. Over the last several years, those alternative pathways have quietly started expanding. Some countries have increased bilateral trade settlement in local currencies. Regional payment networks have started developing. Energy trade agreements are slowly becoming more diversified, and central banks around the world have been accumulating gold at the fastest pace seen in decades. These changes are not dramatic headlines. They are structural adjustments, slow shifts happening beneath the surface of the global financial system. But history shows that when monetary systems begin shifting, the repricing of certain assets can follow. Gold has historically been the primary reference asset during those transitions, but silver often participates in a different way, because silver sits between monetary value and industrial demand. If confidence in parts of the monetary system weakens, precious metals can rise. If the industrial economy continues expanding through electrification and energy transition, silver demand can rise as well. And when both forces interact, silver can sometimes move far more aggressively than most investors expect, which brings us to something many market participants have started discussing recently, the idea of triple-digit silver, prices like $100 or even $120 per ounce. To many observers, those numbers sound unrealistic, extreme, speculative. But once we look at the structural forces building underneath the system, the question becomes more interesting, because the possibility of $120 silver is not really about forecasting a number. It is about understanding what kind of global environment could produce that number. And history suggests that environments capable of producing explosive silver moves have appeared before. If we look back at the history of silver, one pattern becomes very clear. Silver rarely moves in a slow, steady line. Most of the time, it does almost nothing. Years can pass with only modest price changes. Investors lose interest, markets focus on other assets, and silver quietly sits in the background. But every few decades, something unusual happens. Silver doesn't just rise, it accelerates, not gradually, but violently. Large moves compressed into surprisingly short periods of time. To understand why, it helps to look at two historical moments where silver moved dramatically. The first occurred during the monetary turmoil of the 1970s. The global financial system was undergoing a major transformation. The Bretton Woods system collapsed. The dollar was no longer tied to gold. Inflation surged across much of the developed world. Confidence in monetary stability weakened. And during that decade, silver moved from roughly $150 per ounce to nearly $50. That wasn't just a price increase, it was a repricing event. The second major moment appeared decades later, around 2011. This time the trigger was different. The global financial crisis had shaken confidence in banks. Central banks launched massive liquidity programs. Interest rates fell towards zero. Financial markets became saturated with monetary stimulus. And silver once again surged dramatically, rising from under $10 in 2008 to nearly $50 by 2011. Different eras, different catalysts, but both moments shared a similar structure. Silver did not rise because of a single headline. It rose because multiple systemic pressures appeared simultaneously. Monetary instability, financial stress, shifting investor behavior. And once silver began attracting large flows of capital, the relatively small size of the silver market amplified the move. That detail is often overlooked. Compared with many other global markets, silver is actually quite small, which means when large capital flows begin entering the market, prices can move much faster than most people expect. This dynamic explains why silver often lags gold early in major macro cycles. But once momentum builds, silver can accelerate far more aggressively, which brings us back to the present moment, because the global environment today is showing several characteristics that have historically preceded major silver moves: rising debt pressure, geopolitical fragmentation, energy market instability, and gradual shifts inside the monetary system. Individually, none of these forces guarantee a dramatic outcome, but history shows that when multiple structural pressures begin interacting, silver has sometimes responded in extraordinary ways, which leads to the scenario many analysts have started discussing, a price level that for years seemed almost unimaginable, $120 silver. So what kind of world would need to exist for silver to reach something like $120 per ounce? Not a prediction, not a guess, a scenario. Because when we examine past silver explosions, they were never driven by a single factor. They emerged from multiple structural forces aligning at the same time. And today, several of those forces may already be developing. The first is monetary pressure inside the debt system. As global debt continues expanding, governments face a difficult balancing act. If interest rates remain high, servicing that debt becomes increasingly difficult. But if central banks return to aggressive liquidity creation, currencies risk losing credibility, neither path is comfortable, and when financial systems approach that kind of tension, investors begin searching for assets outside the traditional debt structure. Historically, precious metals have filled that role. The second force involves energy and industrial transformation. The global economy is undergoing one of the largest infrastructure shifts in modern history. Electrification, renewable energy expansion, grid modernization, and much of that transformation requires materials that conduct electricity efficiently. Silver is one of the most important of those materials. Solar technology alone consumes enormous quantities of silver. As energy systems expand, industrial demand for silver can increase alongside monetary demand. That combination is unusual because most assets respond to either industrial growth or financial stress. Silver can respond to both. The third force involves capital flows during periods of systemic uncertainty. When financial systems experience instability, capital does not move randomly. It tends to concentrate into a relatively small group of assets: government bonds, reserve currencies, and historically, precious metals. Gold typically receives the first wave of that capital. But silver often attracts flows once investors begin looking for assets with higher volatility and asymmetric upside. And because the silver market is relatively small, those flows can move prices dramatically. Which brings us to an important point. For silver to reach 120, the system would not necessarily need to collapse. What it would require is a period where multiple pressures begin interacting: monetary tension, energy transformation, capital repositioning. If those forces align, silver would not simply drift higher. It could be repriced by the market itself. And when repricing events happen, they rarely unfold slowly. They tend to appear suddenly, after long periods where nothing seems to happen, which raises one final question, not about silver, but about the system surrounding it, because the most important shifts in financial history often happen quietly at first, almost invisibly, until one day markets suddenly realize the environment has already changed. So the real question is not whether silver will reach $120. The real question is something deeper. What is the global financial system beginning to signal? Debt levels are higher than any point in modern history. Energy systems are being restructured. Geopolitical tensions are rising across multiple regions, and parts of the monetary order may be slowly evolving. Most of the time, markets adjust to these pressures gradually, quietly, but occasionally, the structure of the system shifts faster than expected. When that happens, certain assets begin reacting early, not because investors fully understand the change, but because the market begins sensing it. Silver has often played that role in the past, not always, not predictably, but when systemic pressure rises high enough, silver sometimes moves in ways that seem impossible beforehand, which is why the conversation about $120 silver is often misunderstood. It is not really about predicting a number. It is about recognizing the possibility that the architecture of the global system may be evolving, and if that evolution accelerates, some assets may be forced to reprice, sometimes dramatically. So the real question is not whether silver will reach $120. The real question is this: if silver ever does reach that level, what kind of world will we be living in when it happens?